Thank you as always for your waiting patiently for the fourth quarter financial year 2023 presentation. We have Srikanth, we have Kiran Thomas, we have Dinesh Taluja and Sanjay Roy to take you through the performance of each of our business segments. Over to you, Srikanth.
Good evening, friends. This is Srikanth, and I'm starting off with the consolidated financial highlights. So starting with FY23, it's been a record performance led by rebound in O2C and as well as continuing growth in consumer businesses. Our EBITDA at 1,55,000 crores was higher by 23% on a year-on-year basis. Net profits at 74,100 crores was 14% on a pre-exceptional basis and up 9.2% if you consider the exceptional gain in FY22. It was actually the highest ever O2C earnings if you were to look at it on a pre-SAED basis, given tight fuel markets, which are in some sense offset by weak downstream chemicals. Overall, consumer businesses posted EBITDA of 68,300 crores, which is up 30% on a year-on-year basis. Digital services segment crossed the 50,000 crore mark, and retail continued to do well in terms of expansion of footprint and digital commerce. Oil and gas, strong performance, 8-year high with KG-D6 production at 19 SCMD, and also benefiting from higher energy prices. So we have actually doubled our EBITDA and net profit in a 5-year period. So moving to the key highlights, and given that there are presentations that are following, I'm just going to touch upon the main points. In essence, I'm talking about retail, which has grown 30% year-on-year on revenue sense, and EBITDA up 45% on a year-on-year, and then the margin expansion of 70 basis points at 7.8%. So very strong growth, which Dinesh will talk about in terms of retail footprint, in terms of footfalls, in terms of the registered customer base. Overall EBITDA close to 18,000 crores. Just moving to digital services side, revenues up 20%, EBITDA up 25%. At the console level, what we call digital services is crossed the 50,000 crore mark with an ARPU of 179, which is 7% higher. Good growth in terms of net customer add of 29.2 million, taking us to 439 million. Overall, strong growth in traffic, as you can see, 24% higher on a year-on-year basis, and we also crossed the 10 exabyte mark recently. On O2C side, with 62,000 crores of EBITDA on almost 6 lakh crores of revenue. So both revenue and EBITDA were up in the 18 to 19% range and benefiting from strong global oil demand, which obviously supported refining margins. We had a better margin capture, yield optimization, and also the superior product placement. The downstream chemicals, as you know, was impacted, but to a great extent, the fact that domestic demand, was strong, and the fact that, we also were benefited from ethane cracking, given the sharp fall in ethane prices. On the oil and gas side, again, strong performance there. Revenue up, 2.2x, EBITDA up about more than 2.5x on a year-on-year basis, benefiting both from some volume increase, almost 11% higher, and also importantly from the price realization point of view, which was 10.6 million BTU versus 4.92. We are expecting KG-D6 production to commence in the first quarter of 24. Bringing the numbers together, as you can see, revenues almost close to the 10 lakh crore mark. And as I mentioned, EBITDA of 1,55,000 crores, both higher by 23%. EBITDA was led by performance from every operating business, did very well. And net profit at 74,000 crores was higher by 14% despite higher finance cost. As you know, given the sharp rise in policy rates globally, we also had increased depreciation coming on the back of higher network utilization. And also relative to FY22, FY23 had a higher tax rate due to lower availability of tax credits and incentives. So this is just a pictorial bridge. As I was saying, when you look at it, O2C, overall 18% growth, oil and gas 2.5 times what it was, retail 30% growth, digital services 25% growth. in essence, I'm talking about all businesses doing very well, and that's in that sense, it's a very robust performance across all businesses. So when you come to fourth quarter, again, overall EBITDA at 41,000 crores was 22% higher on a year-on-year basis, also sequentially up at close to 8%. And again, this same point about all businesses kicking in, reflects. Overall net profits is, when you look at net profits at 21,327, both on a year-on-year basis, it is up 18%, even sequentially it is up close to 20%. And the fact that higher finance cost and depreciation were actually partially offset by lower deferred tax. This is on a year-on-year basis. On a quarter-on-quarter basis, again, net profits were up 20% and also benefiting from lower tax provision with availing of legacy tax credit as we transition to the new tax regime in FY24. This is just the bridge explaining the fact that all on a fourth quarter to fourth on a year-on-year basis, you can see essentially all businesses growing. Continue in terms of explaining fourth quarter was on a sequential basis. The big jump really came in on the O2C segment, benefiting from polymer deltas, which were actually higher, anywhere between 4 to 25%. Some products like polyester yarn and PET were upwards of 30 to 40% growth that we saw. Also benefiting from a very sharp improvement in gasoline cracks. Oil and gas was stable. Retail portfolio benefited from footfalls, store expansion, and an expanding portfolio. And digital services maintained the momentum, and which Kiran will talk to you about specifically, but all these businesses have done well. So this is an interesting slide. Over the last decade, we have allocated capital in creating, as you know, two strong consumer platforms, digital and retail. And this has really transformed the earnings mix of Reliance and firmly positioned us as a consumer and tech company. The strength of these platforms and the opportunity that they address is clearly visible in the growth that we have seen over the past few years. Both Geo and retail have grown their EBITDA at 50% CAGR when you compare it in a 5-year time frame. And even though the pandemic impacted period over the 3 years, these businesses have delivered EBITDA growth of around 25%. They have invested in state-of-the-art infrastructure. This is technology investments and pan-India delivery footprint in both digital and retail. And this has helped create an unmatched consumer ecosystem that is uniquely positioned to capture the huge India growth opportunity over the coming decades, leveraging the customer insights that these two platforms bring. The competitive cost positions and the huge operating leverage that is inherent in these businesses is clearly visible. As you will note, EBITDA growth has actually outpaced revenue growth across all time frames, really reflecting the operating leverage that we have been talking about, and one is seeing, and we do see a long period of similar operating leverage coming into play. Our energy business continues to generate strong cash flows through the commodity cycles and despite the macro disruptions. And we are allocating capital towards energy transition initiatives that could generate, and that could be the next phase of earnings growth. So when you look at this slide, through the accelerated investments, we have reinforced our leadership positions in the consumer business. In the investment phase, we are ensuring that we maintain our lead in digital services through a differentiated 5G product offering across India. And our 5G services that are already available in more than 2,300 towns and cities in just 6 months from the launch. And we have grown our front-end retail space by more than 60% over the last year, and have further strengthened our logistics and delivery capabilities by adding more than 50% to our warehousing space. importantly, our investments have been funded by internal generation of funds. In fact, I would say that if you see the figures on the left, cash profits generated by Reliance over the last 2 years have almost entirely covered the capex over this period. And as you can see again from the numbers, our leverage continues to be very comfortable with net debt being well covered by our annual EBITDA generation. So when you look at the balance sheet side, given the fact that our capex has been almost entirely funded by our own cash profits, really the net debt is attributable to factors coming primarily from working capital changes and also some of the translation effect of foreign currency liability change. As you know, 8% move in dollar rupee, and you have to restate your liability. So the increase in net debt is coming more on working capital and translation impact. And for us, clearly the continuing emphasis remains on disciplined capital allocation to support growth initiatives. And as you could saw from the previous slide, it is we believe that it will be largely funded through internal accruals. We remain very focused on our superior investment grade ratings that, as you know, we have. And, we continue to focus on ensuring that our net debt to EBITDA remains below 1x. So in summary, strong cash generation, our superior credit profile, does provide us the flexibility to deploy capital in a very disciplined way. With this, I'm going to request Kiran to take us through the digital services part.
Thank you, Srikanth. So this has been the second quarter since we started rolling out our 5G services in Jio. I think Srikanth alluded to that. We started with an initial rollout of just under 5 cities in October of 2022. And as we speak today, we are well on our way towards covering the entire country by the end of this calendar year. Today, present in more than 2,300 cities and towns, with more cities getting added with each passing day. If you look at the number of sites which have been deployed, we are present today in through more than 60,000 sites, which cumulatively mean that we have deployed more than 350,000 5G cells across these 2,300 cities. So this is by far the fastest 5G rollout of this scale anywhere in the world. And by the end of this year, which is just a shade over 1 year, we would have largely replicated our 4G footprint with a 5G footprint as well. What does that mean for us? I think the 5G rollout is really powering 4 really differentiated offerings that we are making to the market. Number 1 is obviously we are strengthening our leadership, already established leadership in the mobility market. We are clearly seeing that with a differentiated offering, present in more than 2,000 cities, as we said, and by the end of the year across India, we will have not just the best 4G network in the country, probably arguably anywhere in the world, but also one of the best 5G networks as an offering in those markets. So in addition to or largely driven by that superior proposition, in the cities where we have deployed 5G, we are already seeing that there is a great increase in consumption, sometimes as high as 3 or 4 times, even from a very high consumption base that we had with 4G. And even without any change in tariffs, what that means is that we can see or we can anticipate a growth in ARPU, just driven by consumption alone. And that's on the mobility side. But if you look at what it means for Indian homes, as you all know, we've been rolling out our Jio fiber services, which is our optical fiber-based home broadband services over the past more than a year or so. But with Air Fiber, which is what we are calling our 5G services, 5G broadband to the home through fixed wireless technology, we can really accelerate the growth of that home broadband base, taking advantage of this pan-India 5G network that we are rolling out. And looking beyond consumers and homes, if you look at our enterprises and SMBs, the 5G service is also powering not just connectivity, but a slew of software services which we are now starting to bundle along with our 5G services and 4G services as we make more inroads into the enterprise segment. So if you look at it, we can really imagine that 5G is really driving what we call the Geo 2.0 opportunity. That is because of the transformational impact that it will have in mobility, in home, as well as in the enterprise segments. To further add strength to the offerings that we are making to the market, we recently launched a Geo Plus, which is a brand new postpaid offering, because postpaid traditionally has been a very strong market for the incumbent competitors in India. And what we are trying to do is really become more aggressive as we enter into this segment. What we are offering is a family plan which allows essentially up to 4 people to share a single postpaid plan. That means you get a single bill for the entire family. You can share the data which is available as part of that combined postpaid plan that you've taken, which means less wastage. We are also bundling premium entertainment through Netflix and Prime Video, Amazon Prime Video. The best tariffs when it comes to international roaming and in-flight connectivity, and obviously all the benefits that True 5G offers through the Geo Welcome offer. All of these bundle into a single bill and a single plan that up to 4 people can share in a household. And because it's postpaid, effectively what we are also doing is offering what we call gold standard customer service, which means priority callback when you need that help, free home delivery, and obviously priority when it comes to portability and other benefits like not having to give any security deposits and so on. So all of the benefits of postpaid plus this great bundle of value that we are offering to be shared by up to 4 people on a single plan. This is one of the first moves that we are making to become even more aggressive as we go after what is traditionally considered to be a stronghold of the incumbents. And we believe that this will have great success in the coming months. And when it comes to homes, I mentioned that 5G is also powering our expansion into the homes. But even on our Geo Fiber plan itself, which is our optical fiber rollout that has been going on, we've been now positioning Geo Fiber even for the people who already have other alternate broadband connections in their homes. And we are calling it as the 198 backup plan, which I will speak about in a minute. And on the other hand, we are looking to further accelerate the rollout of our home broadband offering. Today we are probably already the largest broadband provider for Indian homes. But we are looking to further accelerate by many orders of magnitude through the air fiber solution, which is driven by Geo True 5G, as well as through a very unique partnership that we are entering into with local cable operators or LCO partners, so that they also add their strength and the local relationships and the local presence that they have to become partners to Geo to expand our home broadband footprint. Looking at the backup plan that we mentioned, this is IPL season where a lot of people are very touchy about being disconnected. So what we have really positioned Geo Fiber as, obviously there are a lot of homes who are choosing Geo Fiber as their primary broadband connectivity. But even where people are having some hesitation, what we are really positioning Geo Fiber with this new plan that we are calling as the 198 backup plan is that since you cannot afford to be disconnected even for a minute when the action is really heating up, why don't you take Geo Fiber as a backup? Because our quality and our availability is best in market. So you may be committed to some other plan already, doesn't matter, but why don't you take the Geo Fiber also as a backup? And this is kind of like the second SIM phenomenon. When we started our mobility rollout, everybody thought that Geo would be initially considered as a second SIM, but over time we became the primary SIM for pretty much the largest segment within India when it comes to mobility. And this is kind of like a repeat of that by getting into the household, establishing a relationship, and then being able to upsell and promote Geo Fiber. Once people experience the proposition and the quality of the service, they are confident that they will consider us as the primary option. We are already seeing that a majority of the new users who are taking the backup plan eventually are upgrading to the higher speed plans and all the other entertainment packs and the full slew of offerings that come in the regular plans. So they are upgrading, and we are seeing a great degree of interest for this offering in the tier 2 and tier 3 towns, because it's super affordable. This is a great way, even for people who already have other options, to start experiencing the quality and the reliability and all the other value-added features that Jio Fiber offers. So again, this is another example of how we are becoming a little bit more aggressive when it comes to home broadband as well. And like I mentioned, Air Fiber, which is the 5G-led broadband offering, is what we believe will be the turbo booster when it comes to really taking home broadband even to a much larger number of Indian households. Like I mentioned, by the end of this year, we would already be pan-India when it comes to our 5G coverage. And what this means is that we can, with the same ease of signing up that a customer today has with their mobile service, a customer could opt for a home broadband as well. And we will be able to connect that home thanks to the 5G coverage. And the fact that through the multiple spectrum holdings, we have both capacity and coverage through spectrum in the 700 megahertz and so on. So all of that means that we can very quickly, on demand, provide a home broadband connectivity thanks to the 5G capacity that they created. What has really enabled us to do this is the fact that a lot of the technical components which are required to provide this service end-to-end, everything from obviously the core, the home equipment, and obviously things like the Jio set-top box, which is really bringing that top-class entertainment to Indian homes. All of those are developed in-house, of course, along with a lot of help from very strong technology partners that we've been working with for many, many years. Also, what we have done is we have really taken technology to the next level by using it to plan this entire network upfront. So even as our 5G rollout is going on, we have already done the radio planning as well as the installation planning, so that when a customer really expresses interest to have Air Fiber in their home, we can literally offer that service in a matter of hours. We are looking to launch this as we hit critical mass with our 5G rollout. We are looking to offer this service, the Air Fiber service for home broadband, to augment our already ongoing Jio Fiber rollout in the coming months. Our target really with Air Fiber is that from the tens of millions of homes that we are looking to acquire on a yearly basis thanks to Jio Fiber, now we believe that really we can be more ambitious, and over the coming 2 or 3 years we can really expand that ambition to be present in as high a penetration as 100 million homes through both the fiber as well as the Air Fiber combination. Also, like I mentioned, large enterprises, obviously we are making huge inroads into enterprises. Pretty much every large enterprise that you can think about is already having some sort of a relationship with Jio. We are growing that relationship with every passing day. But the next frontier for us is really what is considered to be largely an untapped market in India, which is the small and medium business. And here, obviously, these are not sophisticated technology buyers. They are looking for some trusted partner to come and create an end-to-end solution. And what that means is that they need pretty much help across everything from connectivity to devices to obviously all kinds of managed service type help and cloud-enabled applications that they can really start using for the benefit of their business. What you see on the right is a simple example that we have recently launched, where we are going to small hospitals and clinics. And what we are telling them is that obviously you could be a connected hospital, but along with that, we are offering them software that is required to manage their operations. For example, we are bundling in C-Square, which is a startup that we have acquired, and they have this software which is one of India's best pharmacy management software. Many of these hospitals have their own pharmacy or homegrown solutions. We are bundling this in almost 25,000 rupees worth if you were to compare other offerings in the market as a bundle, and making it available so that this software can really power the entire billing and all the other inventory management, everything associated with running that pharmacy. And not just that, but through one of our sister companies who's into the wholesale of pharmaceuticals, they actually get some credit so that they can even start ordering and getting some additional margins into their business if they were to start ordering from NetMeds, who is that partner who's providing that medicines to these hospitals. So if you see, it's a whole solution, everything from connectivity to the software that is required to manage their operations, as well as supply, which is required through some of our sister companies from the retail group, all being put together to offer that end-to-end solution to this small hospital. And this is just one example, and there are a number of other examples that we are now launching as we start focusing on segment after segment in the small and medium business area. One other example of how we have been taking that end-to-end solution approach is through JioCinema, which is one of our media offerings. And within the Reliance Group, now we have the rights to stream IPL for the coming few years. And what we have done right in the very first year is create a digital solution where we can take what we call from glass to glass. That is the glass of the camera that is looking at the action on the field, all the way to the glass of the screen where the customers are viewing, and across a number of form factors, everything from smartphones to laptops, tablets, and of course the large screen TVs, thanks to Jio set-top box and other smart TV offerings. Across all of these, we are now able to very seamlessly stream the action, and we have even launched a number of very unique features where you can have a camera angle of your choice, much more interactivity to be introduced in the coming days, but really showcasing the next generation of entertainment experience using this infrastructure that we have created. And obviously we are doing this at India scale. We tested this during FIFA and the Women's Premier League, and we had some great numbers, much more than what we had expected, but the IPL season is really blowing everything out of the water. And this is a great predictor of what is to come, where I think India shifts from traditional broadcast means of enjoying entertainment and other media to truly interactive and streaming-based media consumption. And we have shown the way with IPL and JioCinema, but under the hoods what we have done is really engineer what we would consider as the next highway for streaming media to be delivered to Indian homes. And this could be a platform that we are looking to offer to every other media service provider in the country who's looking to replicate or take advantage of this tectonic shift that we are seeing happening in the entertainment area in India. Quickly moving to the operational and financial numbers now, looking at this quarter. Very strong financial performance continues for JPL. Our consolidated revenues for the financial year 2023 was a shade over 98,000 crores, which is more than 20% year-on-year growth as compared to the last financial year. Our consolidated EBITDA stood at a shade under 50,000 crore, and the growth in EBITDA was even higher than our revenue growth, which actually shows that there is a great degree of operating leverage that is now kicking in as we are unleashing newer and newer engines of growth, largely without having to make proportionate investments. So EBITDA growth we saw is almost 25% as compared to the last year. The quarter alone, the consolidated revenue and EBITDA were a shade over 25,000 crores, which is almost a 1 lakh crore run rate if you were to project that out over 12 months, and over 12,000 crores when it comes to EBITDA as well. In terms of subscribers, I think we are now very nearly almost 440 odd million as of March 2023. And again, ARPU, we have also seen strong ARPU growth, and again, a lot of that is yet to come into the future as the full 5G rollout kicked in, as consumption picks up. But even looking backwards, we saw a nearly 7% year-on-year growth, even when it came to ARPU. The monthly traffic, when it comes to data traffic on Jio's network, crossed 10 exabytes. So for the last quarter, it was more than 30 exabytes, and which is again a 23% year-on-year growth as compared to what was comparable last year. And obviously, as I mentioned, all of these numbers are looking to be further growth. We can expect further growth as the 5G rollout continues, and as we speak, we already have tens of thousands of sites, and by the end of the year, we are really looking to see a dramatically improved set of numbers thanks to that. Again, showing a little bit more of details behind the data growth. If you look over the last 2 years, we can see that the quarterly data traffic on Jio's network has nearly doubled as compared to, let's say, a comparable quarter in 2021. And this increase has been largely driven by additions in subscribers, increasing growth when it comes to home broadband, greater adoption of 5G. And as we speak today, on average, a Jio customer consumes nearly 23 gigabytes of data on a monthly basis. And again, this is a near doubling when compared to the 13-odd GB that they were consuming on a like-to-like basis 2 years ago. And again, this is all thanks to Jio's network, which is one of the leaders in the world, and certainly leader by far in India when it comes to both speed as well as experience. In terms of the key operating metrics, like I said, 440 odd million customers as we exit this quarter, compared to a year back, like to like, that's almost 30 odd million growth when it comes to subscribers. The net adds continue to grow. Again, this is a market leading number. Nearly 6 million new customers joining the Jio family over the last quarter. ARPU growth from 167 ARPU in the fourth quarter of last year to now nearly 180 rupees per month. In terms of total data consumption, like I said, from 24 exabytes to now 30 exabytes over the last quarter. Per data consumption, like to like, a year back it was nearly 20 GB, now it is 23 GB. And again, when it comes to voice, from 1300 odd minutes to now nearly 1500 minutes on a daily basis. Now, all of this indicates a growing levels of engagement of customers. It's not just absolute growth in terms of number of subscribers, but many of the numbers on a per sub basis, both from the data as well as voice perspective, indicates that there is a greater degree of engagement that customers are having with Jio services. Looking at the numbers for RJIL, which is our connectivity company for the quarter for Q4 FY23. Again, you can see as compared to you can see a steady growth that you're seeing in revenues quarter on quarter consistently. If you look at the revenues for RJIL as compared to like-to-like quarter last year, it is now almost 12% higher, and EBITDA margins have crossed 50% now, nearly 52%, and the growth again from comparable quarter last year is nearly 17%. If you look at the entire year, again, a similar story. If you look at the revenues, year-on-year growth of nearly 18%, and EBITDA growth of nearly 25% year-on-year. And this is again largely driven by that operating leverage that I mentioned, and you can really see that is also reflected in the fact that we have now nearly 260 basis points increase in margins as compared to the number that we had last year. If you look at the overall Jio platforms number for Q4, again, operating revenue growth of nearly 15% year-on-year, again driven by the RJIL performance that I mentioned, consistent subscriber additions and an increase in ARPU. And again, compared to last year, Q4 last year, a strong EBITDA growth of nearly 17% with more than 100% year-on-year increase when it comes to margins. And if you look at the reported net profit number, again, nearly 15% year-on-year growth as compared to Q4 last year. And for the entire financial year, again, you can see a strong operating revenue growth, nearly 20% compared to last year. The gross revenue has crossed 1 lakh crore, which is a milestone by itself. And EBITDA growth of, again, nearly 25% year-on-year at almost 48,000 crores for the year. And the EBITDA margins now for the entire JPL group very close to 50%. And again, when it comes to reported net profit, the year-on-year growth of 23%. That I'll hand it over to my colleagues in detail.
Thanks, Kiran. Hi, good evening, everyone. Just to cover quickly the full year performance, we had a 30% year-on-year growth in gross revenue and a 45% growth in EBITDA. We delivered robust LFL growth across all our consumption baskets. In terms of our footprint expansion, we added 3,300 plus new stores, which is about 25 million square feet of area, which is 60% of the area that we had at the start of the year. Similarly, on the warehousing space, we added about 12 million square feet, which is almost 50% of the space that we had last year. Our registered customer base now stands at 249 million. We crossed the landmark of 1 billion transactions during the quarter, which is a 42% growth year-on-year, and footfalls were up 50% year-on-year. Digital and new commerce channels, they continue to grow strongly along with our offline businesses, and their revenue share is maintained at 18%. New commerce business, we crossed the milestone of 3 million merchants onboarded onto the platform. We launched several new formats across our businesses to cater to the needs of specific customer segments. Some of the notable formats include Azort, which is a tech-driven fashion and lifestyle store, Centro, which is a large format departmental fashion store, and Fashion Factory, which is basically brands for less. We forayed into the two large categories, beauty and FMCG business. Within FMCG, we launched the Independence brand, and we relaunched the Campa brand very recently. On the beauty side, we launched the first Tira store earlier this month, as well as the online platform is live. And we continue to explore acquisitions and partnerships to further strengthen our capabilities. On a year-on-year, our revenues came at 260,000 crores, which is a 30% growth year-on-year. EBITDA from operations came at 17,600 crores, which is a 61% growth year-on-year. Our operating EBITDA margin expanded 140 basis points to 7.6%. Total EBITDA was 17,900 crores, which is a 45% growth year-on-year. And profit after tax of 9,181 crores, which is a 30% growth year-on-year. So across both top line growth as well as margins, we performed pretty strongly. Moving on to the fourth quarter, we had sustained growth across all our consumption baskets. Grocery had the strongest performance, followed by consumer electronics and fashion and lifestyle. Our operating margins continue to expand. In fact, we had higher EBITDA for the quarter compared to previous quarter, which is a festival quarter and has the highest consumption. But still, we managed to deliver EBITDA, which was higher than the last quarter. Grocery and fashion lifestyle are the two segments which are primarily driving this. Footfalls for the quarter were at about 219 million, and the number of transactions came at 294 million, which is a pretty strong 40% growth year-on-year. During the quarter, we added 966 stores. So if you track our performance over the last few quarters, from 6 to 7 stores a day that we were opening earlier, we ramped it up to almost 11 stores a day now. So there's a significant ramp up, and this year we added 25 million square feet of total retail sales area under operations. On the digital commerce side, daily orders were up 17%. Merchant partner onboarded growth was 45%, and we crossed the mark of 3 million merchants during this year. Moving on, our overall revenue growth for the quarter was 19%. Grocery on a pretty large base grew at 66% year on year. So it had the highest growth, followed by consumer electronics, which had a growth of 37%, and fashion and lifestyle grew at 19% during the quarter. Digital commerce and new commerce continue to maintain their share in total revenues at about 17%. EBITDA growth for the quarter was 33% year on year. The EBITDA from operations came at 7.7%, which was a 60 basis points increase over last year. So we are seeing sustained impact of operating leverage as we are scaling up, and some of the utilization of our assets are increasing as our depth is increasing. The margin expansion is happening. Specifically, grocery and fashion lifestyle saw a pretty strong growth in their margins. Store count, we crossed the milestone of 18,000 stores during this quarter. Our total store area stands at 65.6 million. We added over 6 million square feet space during the quarter. Our registered customer base is now close to 15 million. So we are able to demonstrate execution at scale across multiple categories, across multiple formats, and people find value in our offering, which is reflected in the kind of transactions and the customer base that we've been able to achieve. Quick summary of the financial performance for the quarter. Revenue came in at 69,267 crores, which is a 19% growth year on year. EBITDA from operations was close to 4,800 crores, which is a 33% growth year on year with a 60 basis point margin expansion. Total EBITDA growth was at 33% at 4,900 crores, and PAT was at 2,400 crores, which is a 13% growth year on year. Just to take you through a few highlights across our key business segments. Consumer electronics business had a pretty strong quarter, growing 37% year on year. Our stores continue to see strong LFL growth, as well as the services business, which is a big differentiator for us. It continues to expand its reach, as well as build on the customer relationships, and that really helps us manage the entire customer life cycle relationship. And which also helps the sales business as well. So that's something that's a big advantage for us. We continue to leverage on events. Republic Day, which was a big event during this quarter. We saw a 35% growth year on year. The growth was across categories, specifically. Pre-IPL, there was a big boost in the sales of TVs, which the business was able to leverage quite well. Rescue business added 200 plus new service centers. They launched new service plans and added new categories into the portfolio. So the business continues to scale up extremely well. On our own brands, we had a pretty strong 100% growth year on year, which is much higher than where the industry is growing. The merchant base is up 80% year on year, and we continue to focus on increasing our wallet share with the merchant base. Our new commerce business within electronics, JMD, it had an exponential growth during the quarter, primarily led by phones and large appliances. We continue to add new merchant partners onto the platform. The merchant base grew 3x year on year on a year-on-year basis. Fashion and lifestyle business continues to grow pretty strongly. We continue to improve our average bill values and conversion rates as our price value proposition in this space is very, very strong. As you are aware, there's a high share of our own brands in our offline business. The growth was quite broad-based across categories. Some of the categories to call out were men's formals, women's ethnic wear, and kids wear, which did very well. The business executed very well, leveraging some of the key festivals and the wedding season. we were one of the sponsors to the Femina Miss India event. And we continue to launch new formats, experiment with new formats in this space. During the quarter, we launched the Gap brand in India and also launched the standalone stores for Portico. Ajio, which is our online fashion destination, continues to grow from strength to strength. It had a very strong quarter with improvement across all operational metrics. We continue to add continue to expand our catalog as well as bring more exclusive brands onto the platform as well as grow our own brands. We now have 13 lakh plus live options on the platform, resulting in very strong performance for this business. Our partner brands continues to do very well. It saw a growth of 35% year on year. This business caters to the premium and luxury segment where the spending continues. The footfalls in the stores continues to be very strong, and this business continues to add more brands, more partnerships, franchises, joint ventures into the portfolio. During the quarter, we entered an exclusive partnership with ELN Cafe for the F&B space, and we also had a JV with Circle E Retail for toy manufacturing for vertical integration for our toys retailing business. Jewels business continues to capitalize on the wedding season and events. There's a lot of focus on launching in-house designs and strengthen our product offering, which continues to find good acceptance in the market. The tier 2 and beyond towns are actually doing very strong for us, while we continue to maintain a strong position in the tier 1 cities as well. Lingerie business, we have multiple brands which span across customer segmentation. All the brands continue to do well. Our revenue growth was up 88% on a YOY basis. There's a lot of focus on expanding the retail presence of these brands, both by setting up EBOs as well as leveraging the various Reliance retail footprint and customer base to really expand the footprint of these brands. This is a technical product, so we continue to innovate and build product capabilities and launch new brands as well as bring other brands onto the marketplace platform. Urban Ladder, which is our home and living business, there's a lot of focus on store expansion as well as building the omni-channel experience for the customers. The business during the quarter leveraged some of the key marquee events to drive traffic as well as sales, as well as we continue to expand external brands in addition to our own products to offer wider choice to the customer. The catalog was up 100% YOY. Grocery had a very strong performance, delivering all-time high revenues as we continue to deepen our presence. Small towns are actually growing very faster. What we have realized is in the tier 2 and beyond cities, these stores act as destination stores and drive a lot of traffic. The growth was broad-based across categories. Some of the notable ones doing very well were fruits and vegetables and staples. There's a significant focus on increasing the share of non-food within our overall portfolio. We continue to expand regional brands into our stores so that we can cater to local preferences as well as take some of these brands on a pan-India basis. Our marquee Full Paisa Vasool sale event saw very strong traction. The revenues were up over 100%. Led by staples, FMCG, food and HPC categories. On the new commerce side, we continue to onboard new merchants as well as expand our geographic footprint. In addition, there's a significant focus on increasing penetration depth in our existing geographies as well as increase the wallet share with our merchant partners. To that extent, we've continued to add in our supply chain capabilities and added 20 new smart hubs into the supply chain network for this business. We are looking at improving the assortment through more local regional assortment so that it is very relevant for the Kirana customer, sell in the market, provide the merchant what sells in that market, as well as grow our own brands portfolio so that we are able to get a higher wallet share with our Kirana partners. Consumer brand business continues its strong growth trajectory. All the categories did very well. We continue to leverage our R&D capabilities as well as expanding our distribution network to launch new products. There were several new products which were launched during the quarter. Most notably, we relaunched the Campa brand, which we had acquired earlier. It was a very successful launch for us. We also bolstered our presence in other categories as well. We entered into a partnership with Malepan, which is a very reputed Singapore player into biscuits, as well as in beverages, launched the Raskik brand, as well as in the confectionery space, the Toffee Man brand. There's a big focus on expanding our distribution network across geographies, as well as enhance the product offering in this business. Our digital commerce business within grocery, JioMart and Milkbasket, continue to grow from strength to strength. There's a pretty strong growth as well as improvement in operational metrics on a continuous basis. There's a big focus on increasing the catalog expansion, bringing new merchant seller partners onto the platform, as well as grow the non-grocery share. To that extent, some of our internal formats like Trends, Hamleys, and Urban Ladder are already live on the JioMart platform, and we are integrating other formats into JioMart as well. Milkbasket continues to expand. It's operational in 24 cities now, as well as it continues to expand its product catalog beyond daily essentials. Pharma business, again, had on a smaller base, had a pretty strong growth at 51% year on year, driven by the online network expansion. We are opening standalone pharmacy stores, which will serve as destination for pharma and wellness products. They will also be enabled and integrated with our online business. That gives us a big advantage to be able to offer omni-channel experience to our customers, which very few other e-pharmacy players can offer. We continue to drive customer engagement through a number of marketing events and other initiatives to drive traffic. New commerce business, it was up 3x year on year and continues to expand its presence. It's currently operational in 2,600 plus cities as of now. That's a quick update on the retail side. Now I'll hand over to my colleagues for an update on the oil and gas business.
Thank you, Dinesh. Good evening, everyone. So just let's do a recap of FY23, and if we see, we have done significantly better than the previous year, and in fact, the EBITDA came in at 8-year highs. Consolidated EBITDA has come in at about 13,589, which is almost 8,100 crores higher than the previous year. EBITDA margins have also come in strongly above 82%, and mainly on the back of sustained production from KG-D6 with the commissioning of both the fields, and we are having continuously improved performance from these wells. Also, higher realizations both in KG-D6 and CBM in terms of price realizations. As we can see, it's more than twice in the case of KG-D6. As such, overall, the uptime in the fields has been 100%. There have been no safety incidents, and we continue to produce from 11 wells from these two fields. In terms of the quarterly performance, when we compare to the last quarter, it was stable performance. The production continues to be sustained, as well as the price realizations also flat. So overall, the last quarter performance was quite stable. We are now positioning for commissioning of the MJ field, which should give us an upside in production in terms of production growth. So just to give you an overview of the project, so testing and commissioning is currently underway. We are happy with the progress. Things are lining up. The subsea production system has been commissioned, and now the entire field is being tested. We expect to commission the field this quarter and commence production. Also, we expect the ramp up from this field to achieve about nearly 12 million standard cubic meters per day this fiscal. Keeping that in mind, we have undertaken the fourth e-auction for sale of gas in KGD6 for a quantity of 6 million standard cubic meters per day. This was quite a successful round. The price bid was JKM plus 75 cents, which is the highest bid that we've received through all the auctions. There were 29 successful bidders. All in all, we are expecting to ramp up the production to a peak of about 30 million standard cubic meters, which will be about 30% of India's domestic gas production and would meet about 15% of India's gas demand. With the customer spread that we have, which is nearly almost over 50 customers, it includes the CGD, power, fertilizers, refiners, steel, glass. So we have a widespread customer base, I'll say a few words about what we think about the outlook in the subsequent slides. So with regards to the overall outlook on gas prices, as we've seen in recent times, gas prices have been a lot softer, mainly driven by a milder winter in US and Europe. In fact, European Union storages have been at historical highs, 50% higher than the last 5 years. However, with the Russian gas supply in the EU likely to reduce to nearly 20% of pre-war levels, the dependency on LNG imports would increase. Now, with no additional LNG capacity additions over the next couple of years, at least not before 25, we expect that should provide support to the gas prices. Further, if we see a revival in demand from China, we expect prices to trend higher. That's broadly the outlook on gas prices going forward and the gas outlook. In India, with lower prices, the demand has been quite buoyant, and as such, with higher domestic gas availability, we now can see that the share of gas in the Indian energy basket has gone up quite a bit, nearly touching 7%. In terms of the regulatory updates, the ceiling price was revised just prior to end of the quarter, last quarter, and for the first half of FY24 at $12.12 per MMBTU, as compared to $12.46 for the previous half. The government has amended the 2014 guidelines applicable to APM gas, but there is no impact on the ceiling price for deepwater, ultra-deepwater HPHT gas. Also, with the unified tariff regulations now implemented, this will largely benefit domestic gas because the cost of transportation will be much lower for customers in far-flung areas, typically in the west and northwest areas. So with respect to LNG, it will be far more competitive in value for customers. That is the domestic gas. So gas market environment remains positive in the medium term. That's our outlook, view, and along with the production upside that we see, it bodes well for the outlook. Thank you.
Thanks, Ajay. So with the last presentation on O2C, this is the year-on-year comparison, almost 6 lakh crores of revenue and 62,000 crores of EBITDA. This is, as you can see, 19% higher on revenue and 18% on EBITDA. Overall, as I mentioned earlier on, this is a record high if you were to look at it on a pre-SAED basis, benefiting, of course, from fuel cracks, because of stronger demand. The downstream margin environment had declined year on year, as you saw from some of the numbers, and polymer margins, for example, anywhere between 15 and 30%. Polyester chain margins were lower by 9%, with subdued demand in China, US, and EU. However, from our side, it was the highest ever domestic sale for polymer elastomers and PET. That in a way it supported realization. Domestic demand was good, and also some benefit of the ethane cracking economics supported our profitability. When you look at it from a 4Q point of view, 16,300 crores, which is higher by 17% on a Q-on-Q basis, as well as 14.5% higher on a year-on-year basis. When you look at it from a year-on-year point of view, clearly benefiting from strength in mid-distillate cracks, competitive feedstock sourcing, and also there's some portion, the performance was indeed impacted by 711 crores of SAED, as well as some of weaker polypropylene and polyester margins. On a quarter-on-quarter basis, the jump, as you could see, is coming primarily because polymer margins were up anywhere between 4 and 25%. POI was up 29%, PET about 42%. So that helped. Also, gasoline cracks went up pretty sharply. It was $5. Last quarter it went up to $15, and that to a great extent offset the lower diesel and jet fuel cracks. And also, cracking economics was aided by a sharp decline in US ethane prices. And the next slide I'll show you the price change there. So this is what I was referring to. You can see that oil prices were lower by $81, lower 8%. Ethane prices at 25 cents per gallon, down 36%. And as you know, if you can crack ethane, then the profitability is good. Overall, oil demand, was up 0.8 million barrels per day on a year-on-year basis, primarily led by jet and kero. This was, and gasoline, of course, that offset some of the moderation we saw in diesel. Overall, what is important to note is strong domestic demand continues to remain good, with oil up 6%. Polymer, actually, we saw 20% growth, polyester a 9% growth. The other part I wanted to highlight was overall, you can see cracker operating rates lower by almost 430 basis points at about 80%, primarily because of capacity additions in China and overall muted global demand. So in fourth quarter, it was about a well-supplied market, and some of the margins were supported by lower feedstock prices. So this is the two charts. One on the top is really the quarter-on-quarter, and then you can see the yearly charts below. But overall, as you can see, numbers even on a quarterly basis, you can see that for the quarter year back, you can see that gasoline demand up by almost 10%, HSD up by 7%, ATF 38%. Of course, ATF benefited from a lower base, but diesel benefiting from farm sector demand and all you can see a lot of positive momentum in industrial and mining activities. But when you see the bottom chart, you can see that overall, when you cut through the volatility of quarter on quarter, you can see that FY23 oil demand is up about 12%, led by ATF, which is up 47%, gasoline demand up 13%, diesel up 12%. So there has been clearly you can characterize it as a strong demand environment on the back of normalization of economic activities, travel, of course. Quickly going to polymer demand, again, quarter on quarter, you can see polymer demand 20% strong growth, led by PVC, which is showing a 67% overall, and PVC demand is coming on the back of agri, on the back of infra and government projects that we are seeing. Also, the fact that PVC prices were lower did support growth, and it is also reflected by the fact that there were significant imports of PVC during in 23. When you put the numbers again on an overall basis, 12% growth is what you end up with polymer demand for the year. Again, pretty strong, of which obviously PVC contributes the chunk of 32%. On the polyester side, 9% growth when you look at 4Q performance on a year-on-year basis, and that you are seeing, of course, PET leading it on the back of beverage sector growth. Tourism played a part, pre-summer stocking up helped. even you can see some of the demand coming through in PSF and PFY with schools, offices, marriages, and all of them. In essence, textile, government sector, all of them doing well. So you can see that growth. Again, when you put the context of the whole year, you can see that polyester remained up 14%, of which PT, and in PET that growth was 28%, and PSF and PFI between 17 and 10% respectively. So again, benefiting from economic activity clearly. So this is the delta environment, and 2 points here. As you can see, overall, when you see it on a quarter-on-quarter basis, you can see that there has been jump in the margins. If you look at polypropylene versus naphtha or PVC, that's anywhere between 4 and 25%, and that, as you saw, is the reason why you saw stronger OTC performance on a quarter-on-quarter basis. Also, as I had mentioned earlier on, US ethane prices declining 36% on a Q-on-Q basis, made improved realization overall. And we continue to optimize our cracker feed for the mixed feed cracker, essentially ethane versus naphtha economics. When you look at it on a FI full year basis, and there you can see that every product, be it HDPE or PP or PVC, all of them are lower on a year-on-year basis, anywhere between 15 and 32%. And really it was about market being well supplied and startup of new capacities, lower demand. All of them had an impact when you look at deltas on a FY23 basis. On the polyester side, chain deltas quarter-on-quarter up 6%, and really there it was about PX margin improving because of tight supplies and the fact that there was a higher value for reformat, and PET margins were also strong on the back of beverages demand. When you look at FY23, however, on a year-on-year basis, polyester deltas were lower by 9%, reflecting margin pressures, especially in energy. There we saw the pressure. That's why the overall fall in delta is about 9%. So you can see that it's the margins are below 5-year averages, and there is some capacity overhang here. So quickly through the transportation fuel, you can see gas oil year-on-year, $22, now $28. You can see that is year-on-year higher, but quarter-on-quarter has been weaker from 42. You saw that fall coming through to 29. So in fourth quarter, you saw gas oil cracks moderate on the back of the Russian diesel supplies still remains firm. It has been an unusually mild winter, and because of gas price being lower, the gas to oil switching didn't happen. So that brought the level of softness in gas oil. On the jet kero side, again, we saw that demand grew, but overall jet fuel cracks also behaved in line with gas oil cracks. So you could see that from $33 in previous quarter was down to 26.5 now, but higher on a year-on-year basis. Gasoline year-on-year flat, but you can see the very sharp jump that I referred to earlier on, where gasoline cracks moved up from $5 earlier on to 15. So yeah, that the demand was there, and it was a surge on because more to do with the fact that there were drop in exports by China because of increased domestic demand, and also significant turnaround amid the storm in the US, where it led to imports there. So you saw gasoline cracks go up. This is just the year-on-year picture about what happened eventually between 22 and 23 as far as cracks are concerned. As you can see, gas oil, the blue line, it was significantly higher on the back of industrial activity, also on the back of lower exports from China. The LNG through the year being very high meant that there was gas to oil switching, which again caused gas oil to be higher. And also EU sanctions on Russia had an impact. That's why you can see $12, on an average being about 41. On gasoline, again, benefiting from increased mobility and lower Chinese exports. And for ATF, again, sharp jump from about 9 to 33, and that's more to do with the fact that travel has really come in a big way, and ATF is actually behaving or in line with how gas oil markets are behaving. So overall demand recovery, lower inventories, China was the reason. In as far as operating through performance is concerned, there was improvement in the primary and secondary units. As I was mentioning earlier on, cracker feed was optimized on the back of lower US ethane prices. We continue to focus on differentiated and specialty polyester products. We have always mentioned about having zero dependence on LNG, and that essentially continues. And we did calibrate the aromatics production. It was optimized on the basically it's a PX versus gasoline is what we calibrated. So that all helped in terms of overall performance. So this is just to highlight the fact that significant work and effort goes in terms of the sustainable aspect related to the petrochemical side, both on it is on recycled polyester, it is on recycled polyolefins, which is both PE and PP, essentially to make them sustainable. We are also a lot of effort going on in terms of chemical recycling of mixed waste plastics to pyrolysis oil. Then work going on biocompostable material as an alternative to plastic bags. Phthalate-free catalyst, that is something that we are focusing on. So a lot of, you can see a lot of effort, and you can see a lot of products too that, that we are work towards, which is, I think, in the long run will be extremely valuable. So this just, talks about, possible demand margin challenges. I mean, it just lists down a few of these things. In essence, we are, from a demand point of view, demand is up almost 2 million barrels per day. And, most of the demand is expected from China, US, and India. And full reopening of Chinese economy could support product. The usual seasonal factors can come into play in as far as driving season and tourism is concerned. And we saw the growth rates in polymer and polyester in FY23, and that really follows the economic growth trajectory. So that's broadly the demand environment side. On the margin side, the new capacities expected are coming more in the second half of 23. There could be potential delays, but and therefore it could keep margin supported. Overall, mid-distillate cracks to remain supported because of the Russian product ban by EU. On the petrochemical side, we saw the volatility in petrochemical side through FY23, and there is so those margins could be constrained by volatile feedstock prices and supply overhang. So those are things on challenges we have to look out for. Whether if oil production cuts were there, if oil prices were to go up, then whether it has an impact on demand. One would look out for increased product exports from China, as well as if US and EU were to contract because of broader slowdown, it has an impact. So these are the factors that we would continue to monitor. On the summary, moving to the summary slide. So I do want to conclude by saying that when you look at it, it is our best ever financial performance, delivering growth across businesses. I think that's a point I would like to emphasize. And energy business, benefited from a favorable fuel market, the fact that there was strong domestic demand, and the fact that we ran our operations were in peak form, and we were able to demonstrate the kind of flexibility that is required. And on the consumer side, Jio, as you saw, delivered impressive performance with traction in both subscriber growth and data traffic. And on retail side, as Dinesh highlighted, the retail footprint, the ramp up in omni-channel platforms, all of them, delivering strong performance. Overall, when you look at it, as we think through our strategic objectives, it is all about strengthening the leadership in consumer business with the accelerated 5G rollout, which is with a very significantly differentiated service offering. We are expanding our physical presence, our logistics capabilities for newcomers, our continued focus on O2C cost position, and more focused on the kind of customer-centric solutions in our O2C business. KGD6 production, as Sanjay highlighted, that will contribute 30% of India's gas production. It's a key energy transition fuel, and for us, developing a very affordable renewable energy system, ensuring progress towards net zero. And importantly, that also is a big driver of earnings and growth we expect over the coming years. So the point I would definitely end by saying that as we pursue our strategic objectives, our investments will continue to follow a disciplined framework and will be largely funded by internal approach. I had highlighted that point earlier on. And we remain focused on maintaining our superior investment grade ratings and in maintaining our net debt to EBITDA at about less than 1. So all this we are going to be delivering. So that means strong balance sheet, strong earnings growth, and all our consumer businesses, we see a long runway for growth there. Thank you so much.